Order! Order! You are an incorrigible delinquent at times. Behave yourself, man!
But first, let me tell you a story about a strange thing that happened last week. The New York Stock Exchange launched a new electronic trading platform. In preparation for this, a company called Knight Capital had created some software to link up with a new platform in order to trade shares on it. The stock market opened, and Knight Capital prepared to launch its new software.
There was some problem with the program. We don't know exactly what.
This is Felix Salmon, finance blogger for Reuters, based in New York.
They switched it on, and immediately they started losing literally $10 million a minute. It looks like what they were doing was they were buying high and selling low many, many times per second and losing $10 or $15 each time. And this went on for 45 minutes, and at the end of it all, they wound up having lost $440 million.
Oops. But how could a company lose so much money so quickly? This is the latest chapter in the story of something called high-frequency trading. Investors have always valued being the first with the news.
1, 2, 3, 4, 5, 6. 1, 2, 3.
But high-frequency trading is something different. Automatic trades, conducted by computers, each one racing to be first. Humans still watch the systems, but the computers move far too quickly for us to react to everything they do. And at Knight Capital, the computer glitch meant the company was making trades it didn't intend to make. That's how to lose almost $500 million in less than an hour. To give you a sense of how fast high-frequency trading can be, imagine slowing down time, so that 10 seconds lasts 30 minutes. In this parallel universe, Usain Bolt ran the 100 metres in just under 29 minutes. It took him 30 seconds just to react to the starter's pistol, and the pistol bang itself lasted 2 minutes. Let's play you just the B of the bang, just the beginning of a 2-minute gunshot sound. And now let me play you some pulses, one pulse for each trade from a high-frequency trading computer. Now that doesn't work. There are still too many trades. In the 1600ths of a second, Usain Bolt is understanding that it's time to run. An algorithm written into a high-frequency trading platform could complete about 165,000 separate trades. That's pretty fast. So let's slow it down even more. The 10-second 100-metre race now lasts 2 months. The 160 millisecond reaction time lasts just over a day, and the bang of the starter's gun lasts 4.5 days. On that incredibly slowed down timescale, here's how quickly the high-frequency trades are happening. And it's getting faster all the time. Now this isn't quite as insane as it sounds. These computers, all competing with each other, are a lot cheaper and more efficient than human traders trying to match bids to buy and offers to sell. So within reason, automated high-frequency trading is a good thing. But it's possible to have too much of a good thing. On the 6th of May 2010, the UK was preoccupied with a general election. But on the other side of the Atlantic, a very different story was unfolding.
We were all sitting around in the middle of the afternoon on a relatively slow news day, and suddenly the Dow Jones Industrial Average was down 600 points in a matter of 5 minutes. There was this huge crash in the stock market for no reason, and then 10 minutes after that it went back up again, and no one knew what had happened.
What may have happened was that somebody rather clumsily tried to make a big trade all of a sudden on an electronic exchange called Globex. As the price dropped sharply in the process of trying to find willing buyers, the algorithms of the high-frequency traders plugged into Globex went into overdrive. And the flash crash wasn't just what happened when the algorithms were in a frenzy, it was also what happened when human beings pulled the plug on all of those individual algorithms.
A whole bunch of high-frequency traders saw a lot of weird stuff going on in the market which didn't make any sense. And they said, you know what? we don't know how to make money in this. This is outside what our algorithms are used to playing, and there's a lot of unpredictable stuff. We're all just going to hit our off buttons at the same time. And what that did was it meant there was no what's known as liquidity in the market. There was no one in the market buying and selling because the market has become reliant on these high-frequency traders to buy and sell stocks whenever anybody wants to trade. And when they all went away, what that meant was you had some crazy trades being done. You had, stocks being sold for literally 1 penny.
What actually stopped the flash crash was absurdly simple. The exchange itself, Globex, shut down.
How it stopped was that Globex has got a program built into it called the stop logic functionality. And in this case, it stopped the system trading for just 5 seconds. But that was in fact enough time to halt the downward spiral. It gave human traders, for example, the chance to just take a quick glance at the rolling news feeds, discover that nothing catastrophic in the wider world seems to have happened, and then to think, well, here, perhaps this plunge of prices is a buying opportunity. So the 5-second pause was just enough to stop things spiralling completely out of control.
That's Donald Mackenzie, a sociologist at the University of Edinburgh who studies financial markets. Professor Mackenzie has been interviewing dozens and dozens of people in the algorithmic trading industry, and he divides the flash traders into categories. First, there are algorithms designed not to lose money while executing a trade that's being placed by a human. Then there are algorithms designed simply to make money by finding buyers and sellers with a small margin between them. Third, there are algorithms which find statistical relationships between different shares or bonds, and when the statistical relationship fails to hold even for a moment, they jump in and make a bet that normal service will soon be resumed. Now, there's nothing immoral about these 3 approaches, but there are more predatory strategies. One is called algo sniffing. Here, a super-fast computer tries to find other computers going about their everyday business of buying or selling shares and figures out what they're going to do and when. The algo sniffer can then get ahead of the game and exploit the slower computer. And of course, you can have algo sniffer sniffers and algo sniffer sniffer sniffers in a high-frequency arms race. No wonder speed can be so important. Andrew Haldane, Executive Director for Financial Stability at the Bank of England, is increasingly interested in how high-frequency trading works and what the future might hold.
What we have out there now is this complex array of multiple mutating, interacting machines, algorithms. The half-life of an algorithm might be as little as a few weeks. So this is a system that's constantly evolving, that's travelling at ever higher velocities, and it's just difficult to know what will pop out next. And that's not an accident waiting to happen. That's an accident that has been happening with increasing frequency over the last few years. We see, mini flash crashes all over the place. Academics have spotted thousands of them, and that is telling us something. That's something to concern us, because it's a signal that this is a system that we don't really get. We can't really peer into. It's the blackest of boxes, actually. We shouldn't wait for the equivalent of the space shuttle disaster before remedying the situation. We already have enough lights on the dashboard flashing red to want to do something differently.
Presumably you're in a position to have a lot of influence. You're in charge of financial stability at the Bank of England. What would you recommend?
There's at least 2 or 3 relatively simple things that could be done. I think one of the most straightforward would be to, on occasions when things are spiraling out of control, we ought to be able to stop the clock. That timeout period will allow prices to be reset, algorithms to be adjusted, perhaps even turned off, and the market to restore some semblance of stability. So circuit breakers, when spiraling is happening, can help prevent a bad situation becoming calamitous.
I'm slightly surprised at the idea that they don't already have these.
In the United States, after the flash crash, they strengthened the circuit breakers they had. The events of the last week have demonstrated that the circuit breakers they have may need to be thought about a little bit more rigorously than they have been. And within Europe, we haven't quite got the equivalent of those circuit breakers in most markets at the moment. So I think there's work there still to be done.
So what are the other two?
Another feature of the high-frequency trading community is that they send into the trading systems loads and loads and loads of messages, many of which they subsequently then cancel. This sending of multiple messages can have really negative side effects for the performance of these systems. It clogs them up. So the equivalent of a congestion charge for financial markets might help lower volumes and make this a freer highway for everyone to trade on. This would be trying to rule out the situations where a high-frequency trader sends in a message and then cancels it before they ever execute. This is different than a transactions tax.
It's a non-transactions tax.
It's a non-transactions tax, exactly.
And the third thing?
In the United States, in 2010, during this so-called flash crash, high-frequency market makers proved to be rather fair-weather friends. In other words, they stopped making markets when the going got tough. There's a question about whether we ought not to put stricter obligations on people to make two-way markets all of the time, not just in the fair weather, but in the foul weather as well.
Andy Haldane, Executive Director for Financial Stability at the Bank of England.
I've been getting away with it all